The Fiat Federal Reserve raised its benchmark interest rate another 0.25% this week to its now highest level seen in 22 years. Payments on the federal government's now near $33 trillion debt level is nearing $1 trillion annually. And while bankruptcy filings for U.S. companies with $50 million or more in liabilities are now spiking to levels not seen since the 2008 global financial crisis and 2020 economic shutdown, Jerome Powell had the following to say in terms of the coming potential of a recession in the USA.
It has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession.
Meanwhile, the bond market thinks the opposite, and this is a current New York Federal Reserve chart illustrating just that. This is the yield curve indicator, and it helps calculate the probability of a recession in the United States 12 months in advance. The term spread is defined as the difference between the 10-year bond and the 3-month Treasury bill rates. When short-term rates are much higher than long-term rates, and the chart line dips, it rings recession alarm bells for anyone able to critically think for themselves. Typically, any dip below the red zero line over the last 64 years meant recession was inbound. Last month, June 2023, the yield curve inversion spread was a drastic negative 1.5508. Consequently, as of last month, the New York Federal Reserve had the probability of a U.S. recession by June 2024 at 67.3054%. A famous quote by a former vice chairman of the Federal Reserve reminds us that before the eventual Fed pivot and next rate cut cycle returns, the last duty current chairman Jerome Powell has is to tell us the truth. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these Bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce Silver Eagle coin giveaway.
Want to win 500 Silver Eagle coins just like this guy?
Yeah, this is Kevin.
Hi, Kevin. This is Dr. Tyler Wall, CEO of SD Bullion. I'm calling you to let you know that you won the SD Bullion giveaway of a monster box of 2022 Silver Eagles.
Unbelievable. That is awesome.
So click the link below for your chance to win.
Good luck to all of you out there who enter our free 500-ounce American Silver Eagle coin giveaway sweepstakes. The precious metals markets were enjoying positive trading weeks until upbeat GDP data afforded large algorithmic sell-offs in the derivative markets and spot prices slid down waterfall price declines. Rallying to close the week, the spot silver price finished above $24.30 an ounce bid, and the spot gold price closed near $1,960 an ounce bid. The spot gold-silver ratio shot upwards to close the week at 80. In domestic bullion industry news, this week the U.S. Mint announced that they will be doubling production of 1-ounce silver American Eagle coins through this coming November 2023. While the U.S. Mint's on pace to break sales records in gold bullion coin sales this year, the U.S. Mint's silver bullion coin sales and market share have diminished dramatically given outrageously high price premiums that have been plaguing the U.S. Silver Eagles consistently over the last few years. As a consequence of this news and the combination of slower summer bullion demand volumes, premiums have been coming down on virtually all silver and gold bullion products in the physical precious metals markets. Late Friday is often the time for a bad news dump as authorities hope to sidestep the news cycle, and that was the case today as it was just announced that a fifth bank in the USA has just failed and been taken over by bank regulators at the FDIC. Moving on to global bullion-related news, India and the UAE have an ongoing 10-year agreement of lessening silver bullion import duties into India for silver bullion coming from the UAE. The import duty discount is currently at plus 9% versus the typical plus 15% tax slapped onto silver bullion imports from common sources such as the UK, China, among others, headed to India. The India UAE silver bullion import tax lowers down throughout this decade into next, to eventually there being no import duties on silver bullion into India from the UAE by the year 2032. You can therefore expect more silver bullion refinery capacity to begin being built out in the UAE alongside their already grown gold refining capacity. As well, many coming silver bullion imports destined to India will likely briefly pass through the UAE in order to skimp on what would be higher import duties otherwise. In related de-dollarization news, India and the UAE announced 2 weeks ago that they've agreed to settle trade in fiat Indian rupees instead of fiat US dollars in an effort to cut down on typical transaction costs associated with interbank fiat US dollar currency conversions. So, bullish future Indian silver bullion demand, bearish long-term fiat US dollar demand. Meanwhile, physical gold demand in China is up both in terms of gold jewelry and sharply in gold bullion bar demand compared to the same period last year, first half 2022. As well, the Chinese central bank has officially added gold bullion for 8 months straight to the tune of an additional 103 metric tons, beginning since November of 2022 through last month, June 2023. After a now 2-decade trade leading baton handoff from the USA to China, globally speaking, we have more de-dollarization news out of China this week. The fiat Chinese yuan now exceeds the fiat US dollar as payment settlement in China's bilateral trade for the first time ever. Nearly now half of China's trade is settled in fiat yuan and has eclipsed their international overall use compared to US dollars, and that is again for the first time ever. Looking at gold prices in fiat yuan terms, they are on the cusp of again breaking out to fresh record price highs. In other words, the lowest levels of fiat yuan values versus gold are going to continue coming. Meanwhile, in Chinese silver prices, they're still just over half of their 2011 price high levels, and therefore good value for anyone who's on that side of the world. Finally, the Bank of Japan made news this week, signaling their policy of yield curve control, that it could be weakening and rates in the land of the rising sun will be rising in a controlled fashion to come. Now, Japan has huge international investments offshore, which may begin further reshoring if local interest rates begin to be more competitive versus massive foreign market bond holdings that they have offshore. Now, a final look at the fiat yen in terms of its ongoing devaluation versus gold. On the left-hand side, we see here, it's already broken out and climbing seemingly higher each and every year to new record fiat yen gold price highs. And as the moon follows the sun, there is silver in Japanese yen terms on the right-hand side, and that's still currently valued at just above 1/3 of its 1980 price high at the moment. If indeed in secular bullion bull markets, gold leads and then silver eventually follows and eventually outperforms, just look at how far silver in Japan has to move to merely mimic what gold has already done over there. Now imagine how silver's typical outperformance might look in an eventual future mania move to come. That's all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.